Hello viewers and welcome back to Dukascopy TV. I'm Natalie MacDonald. Up next in the studio I'm joined by Thomas Saulnier of GAIA Capital. Thomas, thank you so much for coming in today.
Thanks for inviting me.
Not a problem at all. Okay, firstly Thomas, I'd like to ask you, what do you consider to be the key pillars of GAIA's investment strategy?
Yeah, sure. So first of all, it's important to note that GAIA Capital Advisor is an investment boutique specialized in metals and mining, energy and agriculture. And we have a strong bias to emerging markets and to small and mid caps. And the strategy, to select the best available stock within our universe is based on 3 pillars: A, fundamentals; B, valuations; and C, market actions. By fundamentals, we will look at finding the most attractive companies in terms of management, strong assets, strong balance sheet, safe jurisdictions. In terms of valuation, we will look for attractive company in terms of price to book, price to cash flow, EV to EBITDA, price to earnings. And in terms of market action, it's more to make sure that we invest in company where we see some buying pressure rather than selling pressures. And on top of that, we have a strong risk management process in order to make sure that the risk is always under control. We like to run some conviction, what I would call conviction portfolio, meaning that we usually have some concentrated portfolio of 15 to 20 stocks. We just try to make sure we have the 15 to 20 best names within our universe in the portfolio.
You touched there on risk management, and that is something I wanted to pick up on. Given your concentration on assets in less liquid emerging markets and the volatility that comes in investing in products that are very weather dependent as agricultural goods are, how would you describe GAIA's risk appetite then? And similarly, what's your strategy by means of risk management?
Yeah, definitely risk management is key in our strategy because, as you mentioned, the asset class is equity, the geographic area is emerging market. We have a bias to small and mid cap. So in terms of risk, we are on the high end of the universe. So that's why it's really key to manage the risk. We manage the risk on 3 different areas. First, on companies level, so making sure that we invest in strong company with sound balance sheets, with safe assets, strong management team, safe jurisdictions. We also apply the risk management on the position levels. So we have preset stop loss and risk level. So should the stop loss is activated, we will cut the risk on a position. Let's assume that a position loses 15% on the portfolio. We will cut the position, and then we apply the risk management on the portfolio basis, meaning that whenever the market condition deteriorates, we have the ability to raise the cash level, and we have the ability to reduce the risk in the portfolio.
Now, when we spoke to GAIA in Q3, I believe it was, you guys had noted a specific interest in agriculture and farming companies and those organisations which physically produce agricultural goods. Is this a trend that you intend to take into 2014? Yeah,
we definitely think that this is still a supportive investment thematic for different reasons. On a long-term basis, with the population growth and with the change in habits in most emerging markets due to the wealth creation, we think that there is definitely a need for more food supply, and that's why investing in farming companies and in food producing companies definitely makes sense for the mid to long term. Obviously this represents some risk in the short term because, as you mentioned earlier, this is kind of weather dependent, so you could see some volatility, plus you have the QE tapering, meaning that there will be some impact on emerging markets. So definitely in the short term you have to be really cautious. But in the mid to long term, this is definitely a supportive thematic, and we definitely like to be invested in the equities, meaning that you have exposure, indirect exposure to agri-land, so to something that is quite safe with combination of growth. So this is a definitely supportive thematic. Yeah.
And Thomas, the last thing that I wanted to ask you about is, do you feel that perhaps the EM pullout that we witnessed in this summer slowdown of 2013, could that in fact open up some investment pockets within this sector? Which sectors for you are looking interesting for the next calendar year?
Yeah, sure. Yeah, obviously, as you mentioned, in Q3 it's been quite volatile in emerging markets. We've seen some weakness, mainly based on the Fed potential tapering. We think that we could see more weakness or at least more volatility in the short terms. But let's bear in mind that this is where the growth is in emerging markets. This is where the growth pockets remains, and we see a lot of attractive situation in these emerging markets. We think that being selective is key. We still find some really attractive companies. If you look at China, for instance, obviously it's slowing down, but industrial production is up 9%. Consumer good consumption is up 13%. So this is still some very attractive areas to invest in, and the food and farming sectors remain the most attractive ones for us.
Thomas, thank you so much for taking the time to come in today. We really appreciate it.
Thank you, Natalie.
The Dukascopy TV team will be back shortly with plenty more FX analysis and exclusive interviews for you, so we'll see you shortly. Goodbye for now.